Today, we will be talking about Melbourne at breaking point. Inside the housing market under pressure. It's a city under strain. It is not a crash. It is not a collapse. It is something quieter, but far more dangerous. Across Melbourne, thousands of households are reaching a point they never imagined possible. Loan statements that no longer add up. Savings accounts running dry. Families calculating which bills can be postponed until the next pay cycle. The pressure is not loud or dramatic. It is slow, steady, and unrelenting. The kind that creeps into a city until one day people realize the ground beneath them has shifted. Melbourne, once celebrated as Australia's most livable city, is now confronting a housing crisis unfolding in real time. And for many households, the question is no longer, will things get better? But how much longer can we hold on? Melbourne's housing market did not break overnight. It fractured quietly. New banking data released this week revealed that more than 1 in 4 Victorian households is now in mortgage stress. That figure, over 400,000 families, carries a weight far beyond statistics. Each number represents people who spend more than 30% of their income just to keep a roof over their heads. Traditionally, that burden fell primarily on first home buyers stretching themselves to enter the market. But this time, the stress is more widespread. Teachers, nurses, tradespeople, retail managers, childcare workers, the everyday workforce that keeps Victoria running, are finding themselves trapped between rising living costs and a mortgage system that no longer resembles the safe, stable investment it was promised to be. These are not speculative investors. They are families who bought modest homes in ordinary suburbs, believing they were making the most responsible financial decision available to them. A new national report has only deepened concerns. Australia's goal of building 1.2 million new homes by 2029 was already ambitious, but now appears increasingly out of reach. Labour shortages, construction insolvencies, and soaring material costs have slowed building activity across Victoria. Supply is falling behind while demand continues climbing, a combination that inevitably fuels further pressure on households. Meanwhile, mortgage arrears across Melbourne have increased by more than 40% in the past year, marking the steepest rise on record. Banks, reluctant to use alarmist language, have introduced a new term, payment fatigue. It describes what happens when households begin missing repayments, not because they are irresponsible or inattentive, but because they have run out of options. Savings erode, bills are delayed, credit cards become a fallback. Each missed payment, though small, signals a shift from coping to struggling. Behind closed doors, families sit at kitchen tables late at night, running numbers that no longer reconcile. The emotional burden is often hidden. Frustration, fear, and the sense of failing despite doing everything right. For many households, this is not a temporary spell of pressure. It is a structural crisis with no clear endpoint. Victoria's economy depends heavily on its middle class. When this group weakens, the effects ripple outward into retail spending, construction activity, and local businesses. Mortgage stress is no longer an individual problem. It is a statewide warning sign. For years, Australians were told that low interest rates were here to stay. Borrowing was cheap, credit was abundant, and Melbourne, a city with strong population growth and high housing demand, became one of the most mortgage-dependent cities in the country. Cheap money created confidence, and confidence drove competition. Homes sold within days. Auctions drew crowds. Buyers stretched their budgets because the cost of debt seemed manageable. But that era ended abruptly. Between 2022 and 2024, the Reserve Bank of Australia raised interest rates 13 times. The steepest tightening cycle in more than 3 decades. What followed was not simply a shift in monetary policy, but seismic change in the financial lives of millions. The average mortgage rate in Melbourne now sits around 6.4%. Just 2 years earlier, that number was 2.22%. For households with average loan sizes, around $700,000, this difference translates to a jump from approximately $12,100 per month to nearly $4,400 per month. It is one of the largest repayment shocks modern Australia has ever recorded. Most households did not receive pay rises to match it. Many did not anticipate it. And almost no one was prepared for the speed of the increases. The impact is now visible across Victoria's economy. Supermarket spending has declined. Cafe and restaurant activity has weakened. Retail turnover has fallen for 3 consecutive quarters. Consumer confidence, once resilient, is showing clear signs of strain. Economists describe the pattern as forced austerity, where households cut back not by choice, but by necessity. The situation becomes even more concerning when paired with broader demographic pressures. Population growth remains strong. Migration flows have returned. More people want homes, and more households want to live independently. But the rate of new housing construction is slowing, delayed by labor shortages, material costs, and rising insolvencies among builders. The situation becomes even more concerning when paired with broader demographic pressures. Population growth remains strong. Migration flows have returned. More people want homes, and more households want to live independently. But the rate of new housing construction is slowing, delayed by labor shortages, material costs, and rising insolvencies among builders. It is a perfect storm. Demand rising, supply tightening, borrowing power shrinking, living costs climbing. As interest rates rose, another shift began beneath the surface. A change in the psychology of home ownership itself. Australians have long believed that buying a home was the safest financial decision available, a cornerstone of stability, a hedge against uncertainty. But as mortgage repayments surged, for the first time in decades, owning a home began to feel like a liability. Internal bank reports confirm what many suspected. More families are requesting loan extensions, repayment deferrals, or temporary hardship arrangements. The term payment fatigue, once a niche financial phrase, has become a mainstream reality. Households that were comfortably ahead on repayments are now falling behind. Each month, more families transition from hopeful to anxious, from stable to vulnerable. All of this is happening before the full mortgage reset wave arrives. More than 170,000 Victorian fixed-rate loans will expire by mid-2026. When these loans revert to higher variable rates, the pressure could intensify significantly. Melbourne's housing market is not simply cooling. It is absorbing the impact of the most aggressive rate shift in a generation. Melbourne's housing crisis did not materialize suddenly. Its foundations were laid over more than a decade. Years that looked prosperous on the surface, but concealed structural weaknesses beneath. The period from 2010 to 2020 is often remembered as one of Melbourne's golden eras. Record migration, rapid urban expansion, and a construction boom that reshaped the city skyline. But beneath the optimism, several factors quietly pushed Melbourne toward extreme vulnerability. During the 2010s, cheap borrowing costs created a belief that property was both safe and endlessly profitable. Mortgage rates were low. Interest-only loans were common. Apartments and new estates stretched further into the suburbs. Prices across Melbourne doubled between 2012 and 2020, reinforcing the perception that real estate was bulletproof. Homeowners watched their equity grow. Investors expanded their portfolios. Banks were eager to lend, yet this stability was fragile. Melbourne's household debt was rising faster than almost any other city in Australia. By 2021, the typical mortgage reached 6 times the average household income, one of the highest income-to-debt ratios in the developed world. Even before the first rate hike began, many families were already operating at or near their financial limits. Then came the shocks. Global inflation surged. Energy costs jumped. Wages stagnated. And when interest rates rose sharply, all that borrowed optimism suddenly became a daily burden. The National Debt Helpline reported that calls from middle-income earners, individuals earning between $100,000 and $180,000, doubled in just 12 months. This is not a crisis confined to low-income households. It is hitting the center of the workforce. The teachers, the trades, the nurses, the public servants, the people who make Melbourne function. Meanwhile, cost of living pressures amplified the strain. Utility bills across Victoria climbed 26% since 2023. Insurance premiums rose 20%. Groceries remain nearly 10% more expensive than before the pandemic. Households didn't just face higher mortgage repayments, they faced higher costs on nearly every essential expense. This shrinking financial cushion is having real consequences. Savings buffers, once bolstered by pandemic-era support, are being rapidly depleted. The Reserve Bank's own data shows that the household savings ratio has fallen from 15% in 2021 to below 3% today, one of the lowest levels since the global financial crisis. These dwindling reserves mean families have less capacity to absorb unexpected expenses, let alone sustained interest rate increases. Compounding the issue are signs emerging in Melbourne's construction sector. Projects once deemed financially viable are now being shelved. Developers face rising costs and cautious buyers. Some construction companies that survived the pandemic stimulus years are now collapsing under the weight of debts incurred during that period. In the last 12 months alone, more than 2,400 construction firms nationwide have entered administration, many of them small or medium-sized Victorian businesses. These pressures contribute to a phenomenon economists call a slow-motion crash. Unlike a dramatic market collapse, a slow-motion crash erodes confidence gradually. Each month, another group of households falls into arrears. Each quarter, another set of construction projects stalls. Prices edge downward in some suburbs, stagnate in others, and rise just enough elsewhere to create confusion rather than clarity. Melbourne's crisis is not just economic. It is systemic. Every part of the housing ecosystem, from borrowers to builders, is being stretched simultaneously. And as the city grapples with these pressures, another warning sign is emerging behind closed doors, inside the banks themselves. If the visible side of Melbourne's housing crisis is rising arrears and stressed households, the invisible side lies within Australia's major banks, where risk analysts, credit teams, and regulators are tracking developments with increasing concern. Publicly, banks speak in calm, measured tones. They assure customers that the situation is manageable, that hardship programs are available, and that Australia's financial system remains strong. But privately, the conversations are very different. Internal reports from major lenders reveal a trend that can no longer be dismissed: a sharp rise in customers seeking loan extensions, repayment pauses, or hardship arrangements. Over the past 6 months, these requests have risen by almost 30%. This is not a seasonal fluctuation. It is a signal that a growing number of households cannot meet their repayment obligations under current financial conditions. Even more concerning is the language emerging in banking circles. Executives are reportedly preparing for what some describe as a rolling default wave. This is not a sudden market crash like those seen in the US during the 2008 financial crisis. Instead, it is a slow but continuous pattern. Households falling behind one by one, month after month, in a way that is less visible but potentially more enduring. To understand why this matters, consider the structure of Australia's mortgage market. Unlike countries with large rental corporations or government-owned housing stock, Australia's rental supply is overwhelmingly held by ordinary households who own 1 or 2 investment properties. When these investors come under mortgage pressure, the stability of the rental market is directly affected. A rolling default wave among these owners could translate into forced sales, rising rents, and fewer available homes, a scenario that could intensify the housing crisis even further. Regulators are not ignoring this. The Australian Prudential Regulation Authority, APRA, has quietly increased oversight of mortgage portfolios, particularly in Victoria. Banks have been instructed to run additional stress tests modeling unemployment spikes and property value drops of up to 20%. Officially, these actions are described as routine regulatory diligence. Industry analysts, however, confirm they reflect deeper concerns. The core issue is affordability. Melbourne home prices fell 3.8% in the last quarter, the sharpest decline among major Australian cities. But despite the fall, housing is not more affordable. Higher interest rates mean that even lower-priced homes cost more to service than before. This unusual phenomenon, falling prices paired with rising repayment burdens, has left many households in a financial trap. A growing number of Melbourne homeowners are now selling properties not out of preference, but out of necessity. The biggest trigger? The end of fixed-rate loan terms. More than 120,000 Victorian mortgages are set to reset to higher rates before mid-2026. For many, the jump in monthly repayments will be unmanageable. Politically, leaders are struggling to respond. Federal Treasurer Jim Chalmers maintains that housing pressures will ease as new supply comes online, but new supply is years away. Meanwhile, Victorian Premier Jacinta Allen faces rising frustration from local councils over slow planning approvals and stalled infrastructure commitments. In the background, banks are preparing. Forecasts for mortgage defaults in Victoria have tripled since 2022. Hardship assistance advertising has increased. Risk buffers are being quietly expanded. Melbourne's housing crisis is not only reshaping households and banks, it is also upending the very industry responsible for building the homes the city desperately needs. For years, construction was one of Victoria's economic engines. Cranes dotted the skyline, new estates expanded across the city's fringes, and apartment towers reshaped the central business district. But today, the sector is showing unmistakable signs of strain. The slowdown began quietly. As interest rates rose, buyers stepped back. Auctions that once drew crowds now ended with no bids. Off-the-plan sales softened, forcing developers to reevaluate projects already in motion. The logic is simple, but devastating. When developers can't sell, they don't build. And when building stops, an entire network of workers, suppliers, subcontractors, and small businesses feels the impact. Over the past 12 months, more than 2,400 construction firms nationwide have gone into administration, many of them small to medium Victorian businesses. These are not speculative operators. Many were long-standing companies that survived the pandemic, but are now collapsing under the weight of debt they took on to stay afloat during that period. They borrowed heavily when borrowing was cheap, but cheap money became expensive money, and the revenue they expected never returned. Several factors contributed to this downturn. Now coming to the first factor, rising material costs. Global supply chain disruptions sent prices for timber, steel, concrete, and insulation soaring. While prices have stabilized slightly, costs remain significantly higher than pre-pandemic levels. The second factor is labor shortages. Victoria's construction workforce is aging, and migration disruptions reduce the flow of skilled workers. Labor shortages slow projects and increase costs. The third factor is tightened lending for developers. Banks are now more cautious about financing large developments. Projects once considered low risk are now subject to stricter lending rules and higher interest repayments. And then coming to the last factor, falling buyer confidence. Households hesitate to commit to new builds when the market feels unstable. Pre-sales decline, and without sufficient pre-sales, projects cannot proceed. The result is a market that is simultaneously experiencing weak demand and insufficient supply. A paradox that worsens affordability even as prices soften. If the trend continues, Victoria may face a shortage of new homes just as population growth accelerates again. The Housing Industry Association has projected that new home starts in Victoria may fall over 25% in 2025, a staggering reduction for a state already struggling with rising rents and low vacancy rates. Economists warn that the next phase of the crisis may begin not with homeowners, but with builders. If major developers are unable to refinance projects or meet rising interest costs, Melbourne could see a cascade of stalled developments, partially completed estates, and abandoned construction sites. This would freeze the pipeline of future housing supply and guarantee higher rents and prices for years to come. The construction sector's distress also has broader consequences. When projects stop, jobs disappear. Cabinet makers, electricians, carpenters, tilers, plasterers, truck drivers, and dozens of supporting trades all feel the pinch. What begins as a housing crisis quickly becomes a jobs crisis, affecting thousands of families beyond those holding mortgages. Victoria built its identity on growth, expansion, and opportunity. But today, that growth engine is stalling. And as the construction industry slows, the ripple effects extend far beyond unfinished buildings. They strike at the core of Melbourne's economic resilience. Financial pressure doesn't stay contained within spreadsheets or bank statements. Over time, it seeps into the fabric of daily life, reshaping how people work, plan, spend, and ultimately how they see their future. In Melbourne, the housing crisis has begun to influence behavior in ways that extend far beyond mortgage repayments. It is changing the rhythms of the city, one household at a time. Across the metropolitan area, social support organizations are reporting a notable shift in who is seeking help. What was once associated primarily with low-income households is now increasingly common among middle-income families, those earning between $100,000 and $180,000, who until recently rarely asked for financial assistance. Many of these households are dual-income families with children, living in suburbs that were considered stable and affordable only a few years ago. Today, they are calling helplines, meeting with financial counselors, and exploring hardship programs simply to stay afloat. This quiet struggle manifests differently across the city. In Melbourne's west, counsellors are seeing families resort to short-term payday loans just to cover electricity bills. In the southeast, some homeowners are renting out spare bedrooms, or even garages, to strangers to offset rising repayments. In the inner suburbs, parents are delaying having children, or re-entering part-time work after retirement to supplement their adult children's housing costs. These stories rarely make headlines, but they are becoming increasingly common. Meanwhile, the rental market, once thought of as a fallback, is offering little relief. Rents have risen by nearly 15% year on year, and vacancy rates remain stuck at around 1%, the lowest Melbourne has ever recorded. For homeowners under pressure, selling no longer guarantees stability. Moving from ownership to renting simply trades one form of financial strain for another. The choice is no longer between buying or renting, but between varying forms of hardship. The emotional toll of this environment is more difficult to quantify, but just as significant. Financial counselors report rising levels of anxiety, sleep disruption, and relationship stress linked directly to mortgage or rental burdens. For many households, the pressure is constant, a background worry that never fully disappears. It influences everyday decisions: which groceries to buy, which activities children can participate in, whether to visit family members interstate, whether to take a holiday at all. There is also a generational dimension to this shift. Surveys reveal that almost 60% of Victorian renters under 35 have effectively given up on the idea of home ownership. What was once seen as a natural milestone in adulthood, saving a deposit, buying a first home, paying down a mortgage, is now seen by many as unrealistic without inheritance or family assistance. The psychological consequences of that shift are profound. Aspirations change, expectations change. The very idea of what it means to succeed changes. Melbourne is not alone in this transformation. Economists warn that the city is simply ahead of the curve, the first major Australian hub to fully feel the combined effects of high debt, rising rates, and slowing construction. Sydney, Brisbane, and Perth are facing similar pressures, and many experts believe the challenges seen in Melbourne today may soon surface elsewhere. Melbourne now stands at a pivotal moment. The warning signs are no longer subtle, and the consequences can no longer be dismissed as temporary. Mortgage stress is rising, construction is slowing, household savings are thinning, rents are climbing. Banks and regulators are preparing quietly for potential defaults, and public confidence, perhaps the most fragile element of any housing system, is showing clear signs of erosion. Economists describe the present phase as a managed stagnation. It is not dramatic enough to be called a crash, nor stable enough to inspire reassurance. Prices are fragmenting across the city, falling sharply in some suburbs, flattening in others, and rising slightly where demand remains resilient. This unevenness makes the situation harder to interpret. For many households, the mixed signals create confusion rather than clarity. But beneath the surface, the pressure is building. One of the most concerning risks is the possibility of negative equity, where the value of a property falls below the size of its mortgage. Analysts estimate that nearly 70,000 Melbourne households are within 5% of entering negative equity. These households are often younger families who bought at the peak, stretching their finances in hopes of long-term stability. Even a small downturn, a minor fall in prices, a rise in unemployment, or another rate adjustment could push them into a position where selling becomes a loss they cannot absorb. The outer suburbs remain among the most vulnerable. Areas such as Cranbourne, Melton, Tarnit, and Point Cook grew rapidly because they offered affordability. But high debt levels combined with limited savings mean these communities are at the front line of the crisis. What happens in these suburbs will shape the city's broader economic direction. At the same time, Melbourne's construction slump is creating a ripple effect. Fewer projects mean fewer homes. Fewer homes mean tighter supply. Tighter supply pushes rents higher. Vacancy rates hovering around 1%, the lowest ever recorded, place additional pressure on families who might once have turned to renting as a fallback when ownership became unaffordable. For many, that option no longer exists. Politically, housing has become one of the most urgent issues confronting Victoria and Australia as a whole. Governments are attempting to balance long-term planning with short-term realities. The promise of building 1.2 million new homes by 2029 sounds ambitious, but industry experts warn that without immediate structural reforms, streamlined planning processes, and stronger financial incentives, those targets may prove unreachable. And yet, amid the strain, there remains a narrow window for action. Housing crises often force overdue reforms. They can prompt governments to rethink planning rules, reshape the role of social housing, strengthen tenant protections, and foster new financing models for developers. The question is not whether Melbourne can adapt, but whether it will do so before the pressure becomes irreversible. Today, Melbourne is more than a case study. It is a warning to the rest of Australia. The city that once symbolized opportunity is now confronting the limits of a system built on rising debt, rising prices, and rising expectations. What happens next will depend not just on economic forecasts, but on the decisions made in the coming months. For now, one truth is clear: Melbourne is changing. Its housing market, once a source of confidence, is forcing families to reconsider what home, security, and stability truly mean in a landscape where the old assumptions no longer apply.